In this video, we're diving into dollar cost averaging strategy. Let's get started. Have you ever hesitated to invest because you're afraid of picking the wrong moment? Maybe you're worried about a stock market crash right after you put your money in. Or perhaps you've seen people try to time the market, only to end up buying high and selling low. What if I told you there was a way to invest without stress, reduce your risk, and build wealth over time, regardless of market fluctuations? Sounds too good to be true? Well, it's not. It's called dollar cost averaging, DCA, and it's one of the simplest yet most powerful investment strategies out there. By the end of this video, you'll understand what DCA is, why it works, and how you can start using it today to build your financial future. And trust me, you don't need to be a Wall Street expert to make this work for you. Let's get started. What is dollar cost averaging? Dollar cost averaging, or DCA, is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of whether the market is up or down. Instead of trying to predict market movements, you remove emotions from the equation and stick to a consistent plan. Let's say you decide to invest $500 every month into an S&P 500 index fund. Some months, when stock prices are high, your $500 buys fewer shares. Other months, when prices drop, your $500 buys more shares. Over time, this balances out the cost of your investments and reduces the risk of making a bad investment decision based on short-term market fluctuations. Now, you might be wondering, does this actually work? What if I just invest everything at once? How does this protect me from losses? Let's break it down. Why dollar cost averaging works. DCA works for three main reasons. 1. It removes the risk of bad timing. Trying to buy stocks at the perfect moment is nearly impossible, even for professional investors. Example, imagine you had $6,000 to invest at the start of the year. If you invested it all at once and the market crashed a week later, you'd be stuck with a big loss. But if you had spread that $6,000 across 12 months, you'd buy at different price points, sometimes high, sometimes low. But you wouldn't lose everything to a single market drop. 2. It takes emotion out of investing. Fear and greed are the two biggest enemies of investors. When the market crashes, people panic and sell. When the market soars, people get overconfident and buy at the peak. DCA forces you to stick to a disciplined strategy, ignoring the noise and making consistent investments instead of emotional ones. 3. It benefits from market volatility. Volatility might seem scary, but with DCA, it actually works in your favor. Example, let's say you're investing $200 per month in a stock. In January, the stock costs $50. You buy 4 shares. In February, the stock drops to $40. You buy 5 shares. In March, the stock jumps to $80. You buy 2.5 shares. Instead of buying all your shares at $50, you've averaged your cost per share lower. Over time, this can lead to higher returns and less risk. How to start using dollar cost averaging. Now that you understand why DCA works, how can you start using it? 1. Choose an investment. DCA works best for long-term investments, such as index funds, S&P 500 total market funds, ETFs, exchange-traded funds, blue-chip stocks, large stable companies, cryptocurrency for those with higher risk tolerance. 2. Decide your investment amount and frequency. The key is consistency. How much can you afford to invest regularly? Will you invest weekly, bi-weekly, or monthly? Even if it's just $50 or $100 per month, it adds up over time. 3. Automate your investments. Set up an automatic transfer from your bank to your brokerage account so you invest without thinking about it. This ensures you stick to your plan even when the market is volatile. 4. Stay committed, even during market crashes. The biggest mistake people make? Stopping their investments when the market drops. Remember, when stock prices fall, you're actually buying more shares at a discount. This is where DCA shines. Real-world example. Meet John. Let's take John, a 30-year-old who started investing in 2003 using dollar cost averaging. Every month, he invested $500 in an S&P 500 index fund. Fast forward to 2008, the market crashes by nearly 50%. Most people panic and sell. But John? He keeps investing $500 per month like always. By 2013, the market fully recovers, and John has bought hundreds of shares at low prices. By 2023, John's investment has grown to over $500,000 without ever trying to time the market. The psychology behind DCA. Why is DCA so effective psychologically? It eliminates decision fatigue. You don't have to stress about when to invest. It prevents emotional investing. You don't panic during crashes or get greedy during bull markets. It creates financial discipline. You build wealth slowly and steadily rather than making impulsive moves. Think of it like going to the gym. You don't get fit in one day. You work out consistently, and over time, you see results. Conclusion: DCA is your best friend. So, should you use dollar cost averaging? Absolutely. It's a simple, low-stress, and effective way to invest, no matter what the market is doing. Instead of worrying about market crashes, corrections, or headlines screaming about the next recession, stick to your plan and keep investing regularly. Because in the end, it's not about timing the market, it's about time in the market. Dear friends, thanks for watching. I hope you enjoyed this video. If you like it, please subscribe, like, and comment. See you soon.